Welcome to this Killik Explains finance video. This week, how fund investors could be being fooled by EU risk ratings. In other words, MiFID II has brought in key information documents, and within those key information documents, or revised key information documents, there is a risk rating. How useful is it? In fact, how useful is the way they think about products such as funds? Big question, so here's a go at an answer. Now, basically, John Kay in the FT, very experienced commentator, has said the following: the concept of the key information document, about which more in a moment, is admirable. Unfortunately, its execution is a disaster. Strong words. Why? In a nutshell, first of all, for those people thinking, what on earth is a key information document? It is quite important. Now, you may not physically be handed one, you may see this online, but every time you buy a fund or think about buying a fund, one of these things should be presented to you first. So it tells potential investors across the EU what they need to know about a product in a short, comprehensible format. Great, nothing wrong with that. And it is quite a nice short document, actually, as regulatory documents go. An investor can then compare similar products from different providers on a standardised basis. Again, what's wrong with that? If you want to be shopping around, you need some way of comparing one product to another, goes the argument. Key contents, sensible enough. A product description, so what am I buying exactly? Then a slightly more contentious bit, not in concept, but in the way it's been executed, a risk rating from 1 to 7, low to high risk. What you might get back under different scenarios, more about that in a moment, costs and compensation, and how to complain if it all goes wrong. So far, pretty sensible subheadings. So, what's wrong with that? Basically, 3 problems in a nutshell, and we'll go through each one. The use of past data. In other words, John Kay and others don't like the way that risk rating has been built, and I'll explain why in just a moment. Number 2, the assumptions it makes about the way investors think about risk seems to be almost more institutional than what I call retail private investor. And 3, there's a single product focus. Now that's true across most EU financial regulation, but actually it can be unhelpful, and I'll explain why in just a moment. So number 1, the use of past data. So what you get, essentially you get a summary of what you might get back, an average annual return under various different scenarios. And the 3 most common scenarios, the sort of subheadings where you get this data, are these. If you get an unfavourable backdrop or market, not really specified, moderate or favourable. Now I can see what the EU are trying to achieve here. Let's make it all sort of warm, cuddly and friendly. But these terms aren't defined anywhere. So no one's quite sure exactly what they mean. Is that one, the market rising 10%? Dropping? Doing nothing? Who knows? Bit of a mystery. Problems. The projections are based on extrapolating the last 5 years. Now, regulators normally say the past is no guide to the future, but here they seem to be saying it pretty much is our guide to the future. And the maths builds that in as well, as you'll see in a moment. So the problem is this, and John Kay is basically saying, watch out, because some fund projections of performance may be a little bit punchy using the EU's own formulation, because we've had a period over the last 5 years where you've seen government policy stimulating asset prices, quantitative easing, low interest rates and so on. We've seen herding as investors have tried to find yield, get into the best asset classes and so on. All right, and maybe what he's saying is asset prices have enjoyed a run that might in the short term at least not continue. So actually, going back over the last 5 years, saying the past is some kind of guide to the future may not be the right approach. And, as I mentioned, the terminology is not really explained. They're trying to be friendly and cuddly, but without really going a bit further and saying what we mean by these different scenarios. Now, the assumptions about risk. So let's take a look at that one. Number 2. Basically what you get is a risk rating for the product between 1 and 7. A worthy enough aim. Why not? All right, high risk to low risk. But, and there's some maths here that I'm compressing, but essentially there's a couple of important bits I'm going to pick out here, based around, so it's formula-based, this thing, the historic volatility or variability of weekly returns using something called value at risk equivalent volatility, or VEV. Now, there are some eggheads out there who will understand exactly how that's been put together, but essentially it seems that a panel of experts came up with the measure. The important point is it's relatively short term and it uses that kind of language. So, John Kay's point is this. All right, now, he tries to summarise the potential problem in one quote, and then we'll look at it in slightly more detail before we move away from the maths here. If a fund manager has been stealing your money, an investment with them would be described as low risk, using that, as long as they were stealing it at a more or less consistent rate. Is this kind of quip on the fundamental underlying problem with the maths here. All right, and basically, to just sort of extrapolate that a little bit into a second point, the problem with it is that basing a risk assessment around volatility and variability of returns assumes that investors think two-way, and they don't. Most people are more worried about losses and profits. It's human nature, it's behavioural psychology, if you like, and that limits the value of this as a kind of risk measure. But there's more than that. What the EU think and how we actually should or do think may vary. What do I mean by that? What does John Kay mean by that? There's a necessary and mathematical trade-off between risk and return. Yes, okay, that's classic market theory, if you like. Risk is product-based. Is it, though? That's a good question. And investors are encouraged to therefore seek low volatility, high liquidity. So the logic, if you like, of that and that is that retail investors should go for low volatility products and high liquidity. And that will suit them very well. That will keep them out of trouble, if you like. But what John Kay is basically saying, and I don't disagree, is that actually risk is personal to you. You can't just have a one-size-fits-all model. And I know why the EU have gone for a one-size-fits-all model, but that's not the same thing as saying, and that's the right way to do it. All right? Because basically, what risk actually means to most people who are saving and investing for the long term is, will I achieve my goals? Will I be able to pay off my mortgage? Will I be able to fund my kids' education? Can I retire aged 57, 60, 62, whatever it happens to be? All right? So single product risk with a sort of back-tested 5-year horizon and projection of performance. How useful is that stuff, basically, in that context? All right? So for people thinking long-term, which we should be, thinking about their goals, this stuff may not be the most useful way to think about risk. All right? And a technical point, what he's saying basically is this right anyway? I mean, yeah, institutional investors need liquidity. If you're running a fund, you've got to make sure you've got the money available if you get a rush for the exit, as it's called. But as a long-term retail investor, you don't. You can exploit, if you like, that sort of illiquidity that fund investors or institutional investors can't. And relative returns. You know, institutional managers are obsessed by benchmarks. Have I underperformed the benchmark? Outperformed the benchmark? But actually, as a retail investor, you're not tied to a benchmark. You don't have to follow that methodology. So in fact, what he's saying is, you know, the EU's thinking may actually disadvantage retail investors who are prepared to take advantage of structural parts of the market or aspects of the market that they simply don't have to be tied to. Food for thought. Now the single product focus. I mentioned this before. This is like the third criticism, if you like, of the KID document and the way that this whole thing's been thought through. So what do the EU think? Each product should be independently assigned a risk rating. So it's very much a product mindset. It's almost like you're going to buy one product off the shelf, keep it forever, and that's all you'll ever do. But is that realistic? Is that how people actually invest, particularly in the UK? So this reduces the risk, they think, that an investor buys a product that behaves in a way they don't understand. Valid aim, but many investors buy products as part of a diversified portfolio. And if you're buying a fund as part of a wider portfolio designed to achieve long-term milestones, how useful is a single KID document built the way it's been built? All right? So a risky product in that context, that wider context, may even reduce risk if it diversifies a low-risk, low-return portfolio. So by bolting on something which is high single product risk, you may achieve better diversification and lower overall portfolio risk. And that's not really taken account of. All right, so the profile of the portfolio is arguably what matters the most. And that's rather missing. Conclusion then. Here is his. KID's risk categorization is positively misleading and are helpful, inviting us to think about risk in ways that do not correspond to the genuine needs of retail investors. All right. In other words, an over-reliance on the past as a guide to the future, and that may actually end up with funds slightly over-projecting returns, if you like, and this single product focus that tends to assume that people are buying one product, not building diversified portfolios. And also a focus on variability, volatility returns, very short term, in the context of what should be a long-term investment strategy. These are all potential problems with the way the EU wants you to think about risk. Any questions on what is a huge topic? Editor@killik.com. And to watch related videos, killik.com/learn.